Welcome. In this video, we'll explore the traditional model of gearing and capital structure, a structured and step-by-step approach. Topic is gearing and capital structure. This chapter looks at the effects of sources of finance on the financial position and financial risk of a company. It also considers the particular financing needs and problems of small and medium-sized entities. Gearing. Gearing is the amount of debt finance a company uses relative to its equity finance. Financial market value of debt, market value of equity plus market value of debt measures the proportion of debt in the company's capital structure. Operational gearing. Contribution, PBIT. Interest, PBIT, interest. Factors influencing the level of gearing. The decision on how much debt to take on is influenced by internal, market factors. Business confidence. High confidence encourages more borrowing for expansion. Inflation. High inflation can make debt more attractive, as the real value of the repayment decreases. Interest rate expectations. If rates are expected to be low, debt is cheaper and gearing may increase. Restrictions in articles, trust deeds. Legal documents may limit the maximum amount of debt the company can hold. Stakeholder attitudes. Lender attitudes to increased debt levels. Lenders may refuse to offer more credit if the company is already highly geared. Shareholder attitudes to increased debt levels. Shareholders' tolerance for risk affects management's borrowing decisions. Small and medium-sized enterprises, SMEs. SMEs have three main characteristics: unquoted private entities. Ownership restricted to a few individuals. Not just micro-businesses that exist to employ just owner. Financing problems. Funding gap. High failure rates so hard to raise external finance. Few shareholders so hard to raise internal finance. Inadequate security, making banks reluctant to lend. Maturity gap. Hard to obtain medium-term loans due to mismatching of maturity of assets and liabilities. Owner financing, overdraft, bank loans, trade credit, equity finance, business angel, venture capital, leasing, factoring, supply chain finance, crowdfunding, government aid. Equity finance is hard to obtain, equity gap. Major problem is lack of exit route for external investor. Business angels are wealthy individuals who invest directly in small businesses. Informal market may be difficult to arrange. Business angels generally have industry knowledge. Includes the enterprise finance guarantee, grants in enterprise capital funds, supply chain finance, the use of financial instruments, practices and technologies to optimize the management of the working capital and liquidity tied up in supply chain processes, e.g. reverse factoring. Financing by selling invoices at a small discount. Crowdfunding, the funding of a project by raising money from a large number of people.